I'm going to teach you one of the most overlooked ways to find the best option selling opportunities using a concept called autocorrelation. Once you understand it, I'll show you how to use the concept to find the best opportunities for selling straddles and strangles. And just as importantly, when to avoid selling options altogether. Now, insights like this help you design better, smarter trades and avoid the landmines that can really take a good year and turn it into something awful. This insight is going to help you design smarter trades and avoid the landmines that most option traders blow up because of. And if you like this kind of option selling education, make sure to hit the subscribe button. I release videos like this multiple times each week. All right, so let's get this concept locked down before we dive into the actual trading applications. To help you understand autocorrelation, I first want you to picture two people just walking down the sidewalk. The first guy has spent all day at the bar and he's had a few too many drinks. As he walks down the sidewalk, you notice that he starts to drift more and more to the left. He's stumbling side to side, and he just seems to have this lean moving more and more towards the left. Based on what we know about this person, we could probably say it's not too long before this guy stumbles into a pole on the side of the road or off the sidewalk completely. And that would be an example of what we call positive autocorrelation, which is that the direction of yesterday's move helps us understand what today's move is going to look like. If the last step was to the left, and we understand that this person's had a few too many drinks, we can see the pattern of steps continuing to the left. We could assume that the future steps may continue in that same direction. Now imagine person number two, they're walking just a little bit behind that guy and they're completely sober. Their first step brings them slightly to the left, but then they correct, and the next step brings them slightly to the right. And overall, they're walking a pretty straight line where each step just corrects a little bit and keeps them walking a pretty straight line. We would refer to this as negative autocorrelation, meaning that the next move is correcting for the last move. There is some sort of mean reversion. And that's all autocorrelation is. It tries to help us figure out if the moves that we're seeing are trending in one direction or if they're pulling back to the center. So thinking about autocorrelation helps us frame the way that moves are happening. And since in option selling, we're forecasting what range moves will be in within the future, understanding the trend of the underlying and whether it's positive or negative autocorrelation can help us make a better decision about where we place trades. So to summarize this clearly, if we said there was positive autocorrelation and today there was a 1% up move, then we could assume that tomorrow there may be another 1% up move. We could say that the underlying is trend-based and directional. Now, what if we assumed that it was negatively autocorrelated and today we saw a 1% up move? We would assume that tomorrow we are likely to see a 1% down move, because when something is negatively autocorrelated, it tends to be choppy and non-directional. And as for option sellers, what do we want? We want that chop. We want things to stay range bound. If you have questions about that, by the way, feel free to drop a comment below. I respond to everyone. Now that we've covered the theory behind what autocorrelation is, let's get a little bit more practical here. If a stock has negative autocorrelation, it means that it's reverting back to some sort of central point that it's been trading around. And this is exactly what we want to see when we are selling options. In these types of environments, we are more likely to stay range bound, meaning that the underlying stock is more likely to stay within the strikes that we sold. We are also less likely to be delta dependent for our P&L, meaning if the ticker starts to trend a lot in one direction, we'll pick up a bunch of delta and all of a sudden our trade isn't really what we initially wanted it to be. And if things stay range bound, then we're really going to see that theta decay playing to our favor, which is what drives our P&L in options. So let's say a stock is at $100 and on Monday it goes up to 101, Tuesday back down to 100, Wednesday down to 99, and then Thursday back up to 100. This type of price path is what we would call negative autocorrelation. If you're short a straddle or a strangle here, you're not really sweating. You're collecting your premium and the stock's just pinging around. But what if the price action looks different? If the stock's exhibited positive autocorrelation, it's a lot more likely to trend. And that means big moves, which is not good, especially if you're short volatility. So here's the basic way to use autocorrelation in your actual portfolio. Just take a look at the price chart before you place a trade. Is there a clear trend in the underlying stock? Is it just going up and to the right? Is it typically chopping around within a certain range? Because when we're selling options, we should try to seek tickers where there is that negative autocorrelation. We see it chopping around in a range. And if we're seeing positive autocorrelation, we need to be aware that delta hedging is going to be a very important part of our strategy. Now, autocorrelation on its own is not enough to make money. But where it becomes really powerful is when you start to combine it with other ways to measure volatility and forecast which options you should be buying and selling. When you combine your understanding of autocorrelation with understanding implied and realized volatility, understanding the variance risk premium, and understanding what drives volatility around a ticker, all of a sudden you have a complete framework for deciding which trades to take and which ones to avoid. And it's understanding concepts like this that allow good traders to build real systematic strategies. You're not just trading premium anymore. You're matching observable volatility with trade structures that allow you to monetize that risk premium. Now, by the way, if you're ready to trade based on how volatility actually behaves instead of just following what Johnny123 on Reddit says, then click the link in the description below and take a free trial with Predicting Alpha. We have an awesome community. We run 5 systematic option selling strategies together. And during your free trial, you'll have more than enough time to come in and steal those strategies. So come check it out. All right, just like all our other education videos, we ended off with a recap. Here's what we've covered. Autocorrelation shows us how price changes relate to each other over time. Negative autocorrelation equals choppiness equals good for option sellers. Positive autocorrelation equals trendiness equals not good for option sellers. Autocorrelation can be a useful filter for option selling trades, especially when you combine it with other volatility metrics, such as the variance risk premium and implied versus realized volatility. All right, everyone, we'll see you in the next video. Peace.